Setting sun approaching for its world to rest. Long enough to promise all of us its best. Liquid blue and white, crashing through the night. Liquid blue,
Stocks represent shares of ownership in a company. A share is a unit ownership of a corporation profit and assets. Ownership can be quantified by dividing the numbers a share is owned by the number of shares issued.
Stock tables and stock code. 52-week high and low corresponds to the highest and lowest price of stock in the past 52 weeks. Ticker symbol is a unique name used to identify the stock. Divided per share and divided yield are the yearly divided payment per share and the percentage return on the divided respectively. Price-earning ratio is the ratio between price per share and the annual divided per share. Trading volume is the total number of shares traded in that day. Closing price is the price of the share when the market is closed for the day. Need change is the change in the stock price in comparison to the previous day's price at closing.
Bonds. A bond is a loan. It is another way for a corporation to raise funds. They issue bonds to whoever wants to buy them. A buyer of a bond is a lending money to the corporation. What issues it?
Types of bonds. Government bonds are issued by the government to fund programs, meet payrolls, and pay their bills. Corporate bonds are issued by businesses to help them pay expenses. Zero-coupon bonds make no coupon payments but instead are issued as a considerable discount to par value.
Bond characteristics. Face value or par value is the amount of money a holder will get back once a bond matures. Par value is the price of the bond which fluctuates throughout its life in response to a number of variables. Coupon is the amount which will be received by the share bondholder as an interest payment. Maturity is the date on which the investor's principal will be repaid. Issuer is a crucial factor to consider as the issuer's stability is the buyer's main assurance of getting paid back. Example, suppose you bought a bond with a par value of 1,000, a coupon of 8% and a maturity of 10 years. Solution, 1,000 times 0.08 equals 80. The total interest per year for the next 10 years is 80. Bond table. Issuer is the company or a government issuing the bond. Redemption date or a maturity date is the date on which the buyer will repay the investors their principal. Coupon is the fixed interest rate that is issuer pays to the lender. Bid price is the price someone is willing to pay for the bond. Yield indicates the annual return until the bond matures. Usually this is the yield to maturity, not the current yield. The current yield is obtained by dividing the bond annual interest, which is computed on a par value as a principal, by its purchase price. Thus is y equal I divided by P. The buyer's returns is the bond face value plus entries on the bonds received by the buyer from the time of purchase to maturity minus the bond purchase price. Thus R to the base of B equal if plus I to the base of B minus P.